This is the Leadership in Insurance podcast, brought to you by FinPro Search Partners.
Insurance companies are businesses and they need to look for the long term and be sustainable.
We went from 0 to 1 and now it's going from 1 to 100.
Insurance as a concept, as a kind of service, is brilliant. The execution is what we're looking at now.
I think the companies that are going to succeed are the ones that are going to understand and master the art of intent.
When we talk about innovation, we lean too heavily to think about technology and we don't think about creating a culture of innovation.
I think innovation is essentially continuous improvement of existing processes and platforms and product.
Right? It's got to be easy. It's got to be seamless.
Hello and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Ibrahim, who is co-founder and COO of Artio. Hello, my friend. How are you?
Yeah, good, thanks. Good, thanks. How are you?
Yeah, very good, thank you. Very good. Although I'm still sort of surviving London being hot and overcast and all the other things. But yeah, no, we won't moan about that. We'll talk about that beforehand. And it's the most British way to start a podcast ever. Start by moaning about the weather. So I won't do that. Thank you very much for joining me. We had a really good conversation the other day, and I'm really excited to get into the topics that I know we're naturally going to cover by the RTO business. But before we dive in, let's give everyone a taste of who you are, sir, and obviously who RTO are.
Yeah, no, thanks. So at Artio, what we focus on is essentially providing carbon credit insurance from the very earliest stages. There's a lot of nuance in that. So what are carbon credits? Why do they need insurance? X, Y, Z. So I have a little kind of coverage that I like to do, but essentially carbon credit, the way it works in the real world is if you imagine a company like British Airways, for example, they have emissions because they have planes that are flying. So they should be obviously decarbonizing, but there comes a point where they'd have to land every plane to essentially reach zero emissions. So if they think about the fact in, say, 3 years' time, they know they're going to emit 10 tons of carbon and they can't do anything further in terms of decarbonization, at least in the short term. What they can do is invest in a project, say planting trees in Kenya. And then over the 3 years, those trees will remove 10 tons of carbon. Each ton of carbon is a carbon credit. And so then in year 3, they emit 10 tons. They've saved or removed 10 tons through the carbon credits. They're effectively at net zero. So in a really core kind of basic principle way, that's how they work. But obviously, if you're investing in a forest that's going to grow over a period of time, or any other kind of technology, anything like that, there's a chance it could go wrong. The forest could burn down, the developer could run out of money, a whole host of things, which means that British Airways doesn't actually get the credit. And so we essentially created insurance that could work from very early on, so people can deploy capital into these projects from kind of day one. We saw that there were kind of existing insurance solutions in the market, but we felt that there wasn't an offering that started early enough, and we wanted to be able to really push or de-risk that capital that was flowing into these projects so that we can get more of them happening across the globe, and then effectively help kind of reach global net zero targets.
Yeah, amazing. Thank you. I suppose I wanted to dig into that a bit deeper, and I'm going to go off piece of our questions already. Like a thing that I'm doing more and more at frequency. Because I think that's the important thing is that there is lots of other carbon credit insurance type offerings. Well, not lots, but there are emerging businesses. We've had Ocker on similar businesses like carbon underwriting. Is it the how early you get involved in these projects that's the difference, or are there other kind of key differentiators of RTO as opposed to what on the surface might look like very, very similar businesses?
Mm-hmm. Yeah, so I think the key probably at the moment is that we come in very early and we cover quite a comprehensive set of risks. But because we come in, and when I say early, I mean kind of before the project has started, we're able to come in and insure it. The key driver of that innovation, though, really is the risk model that sits behind our insurance. So our approach to this was very much to be data driven. And it draws a lot of parallels from the cyber space. So
Mm,
if you look at cyber kind of 10 years ago, people came in, they were insuring it, they were insuring risks, and what happened over time is people were taking on coverage that wasn't data led, and then you had players like Corvus and Coalition come in who were very data led, understood the kind of vulnerabilities, and provided data driven kind of insurance products that kind of secured the market and really the shape of cyber, which is still moving today. Our approach is not dissimilar to that. So we're very data driven. And when we covered the early stage, we had to do things like build out data sets and risk models. So, for example, we built basically a database of over 8,000 species of tree. And then we have growth models for how each of those species of tree will grow in each country. And so if you tell us the species of tree, say you're planting 70 different species in Madagascar or Kenya or India, we can then forecast the likelihood of growth, how much growth will happen, how many trees will die, and then how much carbon will actually be removed as a result of that. So
mm.
that is probably the key. So obviously the coverage is the innovation in terms of how early we can come in, but what sits behind that is kind of real time predictive model, and that allows us to understand the risk in a way that gets us comfortable, but also carriers comfortable, and other players in the market as well.
Well, what's thank you. Obviously that's the sort of proprietary part of your risk, your risk modeling, and that's what allows you to kind of underwrite differently. Um, Clearly, there's access to data has been a key part of this. Is this a business that could have even been built like 5, 10 years ago? I'm just kind of interested to see the sort of tech and data, the availability of that's led to kind of the ability to underwrite and insure in this way.
Yeah, that's a good point. So when we started, so we officially went full time, me and my co-founder in May last year, both of
Mhm.
us. So I was a little earlier, but both of us were full time from May. So it's been um, about 30, about 14, 15 months now. But the key for us was we wanted to really cover a certain risk, right? A certain set of risks at the early stages. We were like, these are all of the risks that these projects face. So we want to cover all of them. This is what buyers are worried about. So we want to make sure that's covered. And then we want to cover it from day one. And then the question you ask yourself is, if everyone wants this, why doesn't it exist? And that's when you get to the data question, right? Because it always comes back down to data. You don't understand the risk, you can't price it. If you can't price it, you won't provide coverage. And so we went through that process of saying, this is the ideal insurance product. Now we need the data that will allow us to do it. Okay, it doesn't exist. We now have to go and create it. Or if it does exist, it's in fragmented. You have to maybe buy this from there or that from this, and you have to bring it all together. And some of that you can't buy, right? Like some of that we had to just build in house. So I would say that you could have made it earlier, because if you look at, so my co-founder built, he was at Silvera and he was very early on. He built their ratings product. So it's not a dissimilar level of analysis, but it's tailored to insurance, and then it's also really focused on what the risk you are that's protecting. So those things happened, but I think the bigger thing really is the market. So the
Yeah.
actual market itself has been developing over time, right? If we'd have built this 10 years ago, it wouldn't have been the right time for the carbon markets. Even 5 years ago, it wouldn't have been the right time for the carbon markets. I think right now we're seeing this perfect storm of institutional capital coming in, and that means people like our partners, so Tokyo Marine, HCC, Markel and Apollo. These are kind of institutional insurance names. They're now fully kind of behind the carbon markets. We're seeing banks, multiple banks getting involved, looking to deploy traditional debt capital. We're seeing obviously corporates have always kind of been involved, but that's the switch we're seeing now. Is it's much more institutional capital coming in, and that's where you'll get scale. And obviously that's where insurance comes and plays a big role.
Yeah, yeah. I suppose to that, to sort of complete that thought as well, is that um, i- it's good that there's competitors that people kind of trying to understand what's different and where, because it's that kind of there's still that education piece. I would imagine to a certain extent, probably more. I don't know, where is the education piece coming in? Because I suppose that some of this is being mandated, some of this is kind of regulatory driven. And I can see it increasingly being so, like demands being put on businesses to kind of offset carbon emissions, etc. That's obviously a driver here. But how much does education and educating the kind of maybe distribution partners or consumers come into the buying of this insurance? Is that part of the challenge, or am I overstating that challenge?
No, you're definitely right. I think there needs to be education every step of the way, and that's both parts, right? Because the we're not the only carbon insurer that's in the market. There are other players, and they have had been in the market slightly longer than us. So it's being able to understand how that has sat in the market in terms of insurance, but also the wider carbon credit market, right? It's how do people want to interact with it? Is it good? Is it bad? Like that's actually a fundamental question, because people that have never interacted with the carbon markets sometimes come in with this perception that they're not working in the right way, or they could be linked to greenwashing. And that's something that with proper kind of robust due diligence and looking at the right projects and looking at the right project types and looking at the right players and such, you can kind of dispel that. But that takes a level of understanding beyond the initial what is a carbon credit. And so that will continuously be doing, whether it's sometimes with brokers, sometimes with corporates, sometimes with wider players in the market. You have to continuously be educating people and also be educated yourself, right? Like you have to be open to the fact that someone will tell you things in a way that will shape how you look at them. And it's very important to understand that, like, if a broker doesn't understand the product, then they're not going to be able to sell it. If a corporate doesn't understand why they need it, then they're never going to take it on, but they're also probably going to take longer to do it. So yeah, education will always be important, I think, in this market. But yeah, we have a job to do as players in the market to not overcomplicate things, try and make them as simple as possible. You know, as much as people act like this is a brand new world, insuring, I don't know, energy or renewables infrastructure, is it a million miles away? Probably not. There's more parallels than there are not parallels, and so we just need to think about that. Let's make it simple. That's how you make it scalable. But yeah, be able to educate people always.
Yeah, yeah. That's my investing thesis actually. Whenever I'm sort of uh looking at making certain angel investments, and you know I've made a couple in the last few years, I'm like, right, I'm a simple man. If I can understand it, then it's worth my money, because it's like, how simple is the explanation? And that's a massive oversimplification of my investing thesis, but it isn't much more complex than that. And it's similar to when people come on the podcast. I'm like, if it takes too much to explain, it's probably not, there's product market fit isn't there, particularly on insurance, because insurance is a, you know, relatively simple. There's a risk and there's a price for that risk, and therefore we offer insurance on that. But I think the education point is it's evolving as well. I mean, I remember reading and I actually read this. I keep saying I've read this, and I'm like everyone else. I actually saw it on a reel, but
Yeah.
I did actually read this in a Wired article. It was about the a lot of fraud in the carbon market, and yeah, some of the projects not being to completion. And I think that as well is this sort of dealing with the negative press of the markets as well. How much is that? Does that factor in to kind of? Does the data kind of mean that that's avoided? Is there a risk of kind of fraudulent activity in relation to what you're doing? And I appreciate this is a completely off-piece question, so you
No,
can
no,
you
no, it's
can
fine.
have your wish.
It's what matters. Yeah, yeah, no, it's definitely what matters. So first and foremost, fraud is something we cover, right?
Yeah.
As a peril, as part of our insurance, we do cover that risk. So that's important. I think the idea that there'll never be any fraud in any market is always not right. Right? There will always be in some way, shape, or form. So from a buyer's perspective, we want them to feel comfortable that that risk is covered, and it's important to know that they've taken the steps to make sure that's the case, right? So you always have to do your own due diligence on whether, you know, the party that you're working with is appropriate. They haven't got any historical bad press or anything like that. But that's also stuff that we look for. So we'll look at the historical kind of success of the developer, whether there's any fraud cases linked to them, things like that. And so it's definitely a conversation that comes up. But our thinking has always been, if you do the right due diligence and you have structures in place i.e. insurance, to cover you from the risk. What you're doing is every step you can feasibly take before engaging in a market or in a project, right? There'll always be things outside of your control. There'll always be bad actors. But as long as you're taking the right steps, then you can negate the risk of that, and it's less kind of systemic in the market itself. And then I think the wider problem will always be, so carbon, it's hard. There's a bit of a tangent. If you look at
Go for it. We love tangents.
carbon markets as a whole, fundamentally, if I tell you, you basically can have emissions and then use carbon credits to offset those emissions, people sometimes say, oh, that's a purview to basically just emit more. But that's never what the goal is, and it's never what kind of is advised in any formal structure, whether SBTI or whatever the kind of body is. It's essentially saying you need to decarbonize, right? Everyone accepts that. So decarbonizing is very important. And one of the good analogies that I like to use is the tube, right? So people get the tube. I'm assuming you get the tube into work, and it's really good that you're decarbonizing, but not by not using your car, right? So you're already taking that first step. You're not driving into work, so there's less emissions. And then you're getting a kind of shared transport. That's also really good. But there's still a level of emissions that exists because of your use. So every year, there's a tonnage of emissions that happen, and only way you can negate that now is to stay home. But you can't stay home, right? And so that emission that's left over, a residual emission, is what carbon credits are great for. So you do everything you can to decarbonize, and then what's left over, the residual emissions, the ongoing emissions, the historical emissions that you can't do anything about, you then use carbon credits as a way to essentially address those. And that's how we kind of use the markets together. And I think once people can really understand that piece, they can enable it as part of their overall kind of approach to net zero. And then that's how we get to a place where, you can negate the idea of kind of bad press, or is this a right market, or is there going to be fraud, because you're taking the right steps in a structured way and then mitigating risks where you need to.
Mm-hmm. Yeah. Thank you for that explanation. I think we've had several people on who haven't kind of like put it in that way, because I think there is that thought process that everyone's just going, well, great, these companies don't really care, so they'll just buy up these carbon credits and they just keep polluting as they wish. But the sort of evolution towards decarbonising and doing this alongside is really important. And then also every time we have one of these conversations, I remind myself that I need to offset the amount of travel I do for work. But that's a side issue for me to think about another time. Ibrahim, I wanted to get into your background, because you've had quite an interesting journey to this point. Some of the founders we've had on in this space are coming from like, kind of a related field, sort of environmental, like carbon credit, carbon capture. Well, that's not your background. Is it Deloitte, then venture, then a startup as well, wasn't it, as well? So just interested to see why you've ended up here in this kind of climate / insurance crossover, because seems like you've stumbled into insurance like everyone else tends to do.
No, it's a good. So first and foremost, I think, so my co-founder has been in the carbon markets for quite a long time. Like I said, built Silvera's rating product, and then he also built a geospatial AI product. We're like old uni friends, so we were in the same corridor at uni. That's where we met. But we've continuously looked at. We always wanted to build a company in the climate space, particularly. So with that social good at heart. So we've basically been talking continuously over that period of time. So from finishing uni to starting Artio, about how we build something, what's needed in the market. And one of the key things that happened was around the time we were thinking of starting Artio, is we were having the discussion about the carbon markets and the fact that they needed to scale. And obviously came back to that data point that we were discussing. And we sat down and we said, okay, where are the gaps? And obviously the gaps that existed on the carbon side were very, very evident. But the other thing that existed was a fundamental lack of deep financial analysis, and then deep kind of governance and political risk analysis as well. So these are the more fundamental things. So you have to get all of the carbon, climate, methodology side right. But the other thing you need to get right is this project actually going to survive? Does it have the cash flow to be able to deliver. Because if they run out of money in year 2, they're not planting trees, or they're not setting up a biochar facility or XYZ. So that's where my background really came in. Is when I was at Deloitte, we were basically auditing venture capital funds, so primarily working on the Vision Fund, and they essentially were a big fund that was investing in startups. So companies like Uber, WeWork, a whole host of others. And then it was our job to essentially assess the valuation of the companies that they invested in. So you'd often have very limited information on new markets, and you'd have to build out either full financial models. It's something I've also done in my spare time a lot, right? You have very limited information. You use what information is available. You kind of gather as much detail as you can to rebuild kind of sensible, robust financial forecast models. And then I did the same thing. I went to an early stage startup, which was alt data. So they basically took live transaction data and turned it into products so that you could get a read on kind of market spend. So how much are people actually spending at Tesco month on month versus last year, things like that. But live consumer spending data, which obviously has real value. So hopefully from that perspective, you can see where then it became quite clear, right? I had this ability to basically build like robust financial models based off very little data that's available. So that's what I did for the carbon markets, essentially. So I built a cost database of like every ARR, every country that we cover. What does it cost to basically build a reforestation project in that country? What a fertilizers cost, what a pesticides cost, like really fundamentals. But then at least we can say, okay, well, if you're going to build a project in this country, this is how much it will cost, this is how much you need roughly, and then we compare that to what they do. So that's how my background came into that really usefully. And the same thing happened across like governance, like how well will this project succeed, how well did it do before, and then that all obviously culminated also in this core concept of, which I'm sure you've seen before, what is a startup? What do you actually need to get a startup off the ground? Because that's a whole separate like world, right? Of you know something's needed, you know you need to build it. Our backgrounds weren't insurance, me and my co-founder. So the first thing that we had to do was, we obviously knew that insurance was needed, but we had to basically get our non-exec director in. So her name's Lindeen. She was Chief Climate Product Officer at Zurich. She's had years and years of experience in building climate-focused insurance products, and she is, invaluable part of the team. She used to describe us not too long ago, still to an extent now, but we're two guys, a girl, and a dog is how she would describe us in all of our carrier conversations. Make it clear that's what we are, but we're a strong team. We kind of knew what needed to be done, and we knew about like using historical understanding of the insurance market at senior level, product innovation, bringing that in with like industry level expertise and data that was available to kind of come together. And then I had to very, very quickly learn what an MGA is, what a cover holder is, how everything works in insurance. I feel quite comfortable in the room now, but yeah, it's a whole niche world, right? That if you're exposed to it, half the people I talk to still think that I work in the Lloyd's Bank building or something, and I'm like, no, Lloyd's of London is another thing. That kind of big weird building in the middle of that. That's like, okay.
It still makes me cringe / slightly embarrassed on their behalf, is that when I'm reading like financial press and they talk about Lloyd's as an insurer rather than an insurance market, and it just bugs me. 20 years in, I'm still going, kind of. But yeah, anyway, side note. How did you just actually, how did you find Lindeen? How did that come about? Did you reach out to her, or?
We did a lot of like, had really hard to find her. Actually, we started reaching out. We spoke to like maybe 10 people at the time to decide kind of we needed someone. We actually were introduced to her through there's a program in New York, it's InsurTech NY, it's called, I think.
Yeah.
But basically, yeah. And so the person there, so David Gritz from there, we'd been speaking to him for a while, and there were a couple of people we were already talking to, and that was firm cold outreach. We found people that had like good expertise in the market, and it was regular old like on LinkedIn messaging them saying, hey, talk to us, talk to us. And then he introduced us. We told him we were looking. He introduced us to her and a couple other people. But the great thing about Lindine was we were talking to her about potentially joining, and by the week after, she'd already started work on one of the projects that we needed help on. And by the time we actually signed, like she'd almost finished the first thing that we were asking for support with. And that's the great thing about her. She just like picked up and was doing things. She was like, I get it. I'm with you. I understand why this is important, and I know what you need, and I'll get that to you as quickly as possible. So yeah, it was a no-brainer for us.
That's amazing. That's amazing. And David's a really good friend of the business, and so yeah, we think a lot of those guys out there, and actually, it's just endless stories of them just for no benefit necessarily of themselves going, "Oh, okay, I can introduce you to so and so," and it's yeah, they're good guys. I'm really conscious of time. Actually, we're nearly there, but I always like to sort of end on a future focused question about what's next. Obviously, you've been through the lab relatively recently. What can we expect to see from you in the next 6 to 12 months?
Yeah, no, it's a really good. I think the core for us now is we managed to kind of launch our product quite quickly, probably quicker than expected. We're now firmly in the market competing for business. So the key for us now is a lot of those transactions that are closing. You'll hopefully start to see some of those announcements being made. Obviously, they're kind of not our announcements to make because the insured is the one that's kind of deploying capital, but you'll start to see some of that over the next 6 to 12 months. So household names, big players in the carbon market, going forward with transactions that are insured and kind of signed off from Artio's perspective. So that's important to us, right? Is the key you want to see is the number of dollars being deployed into carbon projects from very early on, enabled by us, right? We're not the developer, we don't do the work, we're not the person deploying capital, but we are basically taking on a lot of the risk so that we can make that transaction easier for people to do. And that's the key for us. More capital being deployed, and you'll start to see kind of that little bear logo that we have cropping up all over the place behind transactions to say that, we try to de-risk this enough so that you can see more of them happening and more money going into projects when they need it.
Amazing. We didn't even touch on this, but I need to end on this comment because we didn't talk about distribution models or anything, but as much. Actually, no. Come on, I'm going to extend it. We're going to have to go a bit longer because you've got multiple distribution partners and models, and I just wanted to get into that because it really serves the kind of insurance as a kind of force for good, which we're gonna spend a bit more time, so we need to pump that message out there in the industry. So let's talk about distribution quickly, and then I'll wrap up if that's okay.
Of course, yeah, of course. So we have a couple of different distribution channels. So we obviously go direct. We also go through brokers. There's a lot of good brokers in the space, but one of the ones that's really interesting is what we do for developers. So project developers are obviously the people on the ground that are planting trees or setting up kind of direct air capture facilities or enhanced rock weathering. And what we essentially do is a completely free insurability assessment because essentially all of the risk modeling that we do is in-house and everything in terms of the data we create, XYZ. So we can run our risk model at relatively low cost, just my time, which is worth as much as other people say it is apparently. But yeah, so we're able to run that process. And what we do for these developers essentially is we run their project through our full risk modeling. And then we give them insights on what the risks are. So if the project does pass our risk modeling checks, we can issue them an insurability letter, which basically says, we're a regulated insurance company. We're saying that this project is insurable. They can then use that in the market when they're talking to potential funders to basically say, look, we're a de-risk project. You can get insurance to on that, and it helps them in that discussion. Whether they are insurable or not, we also share with them a really high level output. Like, here are the risks that we've identified. For example, we had a project that had like a really high fire risk. So our climate risk model said that this region of their project is exposed to fire, and they didn't have a fire mitigation plan in place yet. We're really early, right? So they came to us, they we told them, look, if you can put a fire mitigation plan in place, come back to us. You also have this species of tree that's fire resistant. If you plant that in this region, you reduce your risk of fire. Sorry, you reduce your risk of fire hugely, and then come back to us. We'll rerun it, and then if you're insurable, you then will be insurable, and we can issue you the letter. But really, for us, it's being able to provide tools like that to all developers. It doesn't matter, you don't need a special commercial relationship with us or anything like that. If you're a developer that's working in the areas that we cover, we can provide this for you. And then we're able to give you the tools to basically secure what's important to them, which is investment, as soon as possible. And that's how insurance should really be interacting with this space, right? We're de-risking, but de-risking doesn't mean just placing the policy. It means sharing those insights. We can kind of forecast the likelihood of fire, flood, drought, and storm over the next 30 to 60 days. And if we see there's an increased risk, we can just share that with the developer or the insured. And that's that area of like proactive risk management that we're trying to bring in. Is we don't want to just give people, here's the insurance, you can step back and think about it. We also want to give everyone the tools to kind of prevent these things happening or mitigate where possible, because climate risk is a big question mark right at the moment across the insurance industry. And for us, it's if we have all the tools, if we have the data, if we have the models, if we share those insights, we can prevent things. And that's what we all actually want, is not to go through an insurance claim or anything like that. They want to be able to kind of survive and persist with the work that they're doing.
Yeah, exactly. And that's why I thought it was important to keep that going, because I think it's that enablement of people that are doing good work. And this risk mitigation strategy, and it's the crossover with the cyber market as well, isn't it? It's that continuous risk monitoring. So thank you for letting me extend a bit of your time just to cover that off, because I thought it was really important. Ibrahim, thank you so much. It was a pleasure meeting you the other day, and I knew this would be a good conversation, and it hasn't disappointed. So thank you so much for being a guest on the Leadership Insurance podcast.
No, thank you for having me. It's been really, really good talking to you, but before and during this as well.
Good man. Thank you so much.